Welcome back to Investing Talk Podcast. Feeling like the market's about to hit a rough patch? Well, we're diving into 10 stocks that could not only handle a bear market, but maybe even do well in it.
Yeah.
Think of it like prepping your portfolio for when things get, well, a little wild.
Yeah, exactly. We're focusing on companies in sectors that tend to hold strong when the economy weakens. The ones with a history of steady dividends and those whose prices don't jump all over the place.
So less of a roller coaster ride for your investments then.
Exactly.
All right, so let's jump right into our list. We've got Johnson & Johnson, ticker symbol JNJ. Then there's Procter Gamble, that's PG, Coca-Cola, COK, Pfizer, PFE, Verizon, Z. And let's not forget AbbVie, ABBV, Walmart, WMT, Merck & Co., that's MRK, AT&T, and finally, Mondelez International, MDLZ.
A really good mix of companies there, and they're all from different sectors, each with their own strengths and potential.
Let's kick things off with Johnson & Johnson, ticker symbol JNJ. I mean, they're a classic example of a company that can weather just about any market storm, right?
Yeah. Absolutely. If you look at their performance, it tells a story of, well, resilience. Their adjusted earnings per share for 2024 came in at $9.98, a bit up from last year. And what's really interesting is that even with those legal settlements, they still managed to beat what the analysts were expecting.
That's got to be reassuring for investors, especially when the market feels a bit unpredictable, right?
Oh, for sure. And on top of that, their revenue growth is pretty impressive, too. For the full year 2024, they hit $88.8 billion, a solid increase of 4.2% from 2023. And a big part of this growth is thanks to their shift towards those high-margin pharmaceuticals and medical devices.
So they're not just, sitting back. They're adapting to the changing landscape of healthcare.
Exactly. One thing that really stands out is their focus on that new blood thinner, milvexian. It's in those late-stage clinical trials, and it's designed to be easier to use and possibly safer than what's already out there.
Sounds promising.
If it gets approved, this could be a huge deal in preventing strokes and a major growth driver for Johnson & Johnson. What do you think? Could milvexian be the next big thing?
It definitely has the potential. Those kinds of innovations are super important for any company in the pharmaceutical industry.
Yeah, absolutely.
And it's not just about new drugs either. They're a dividend king.
Yeah.
And for those who don't know, that means they've increased their dividend payouts for at least 50 years straight.
That's right. They have an incredible track record of rewarding their shareholders no matter how the market's doing. And their current dividend yield is a healthy 2.99%, giving investors that reliable passive income, especially when there's so much uncertainty.
It's that stability that investors are looking for, especially in a bear market, right?
For sure.
Okay, let's move on to another company everyone knows, Procter & Gamble, ticker symbol PCRE. Yeah, they're all about stability.
Procter & Gamble is the perfect example of a company that does really well when people are looking for value in brands they trust. Think about it. Even during a recession, people still need things like toothpaste, detergent, diapers.
The essentials, right.
Right.
And their second quarter results for fiscal year 2025 show exactly that. Their core earnings per share were $1.88. That's a 2% increase year over year. Might not sound like a huge jump, but for a company this big, it shows they can keep growing, even when things are tough.
It all comes down to organic revenue growth, and they're really good at that.
What exactly does that mean?
It means their growth is from selling more and adjusting prices, not from things like acquisitions. So they saw a 3% increase in organic sales, meaning people are buying more of their products.
And that's impressive, especially since they already have a big chunk of the market.
Right.
Now, I know a lot of investors look at the PE ratio to get an idea of how a company is valued. What's Procter & Gamble's PE ratio looking like?
Well, we don't have a precise number from their recent reports, but historically they've traded at a premium compared to the overall market. That means investors are willing to pay a little more for their shares because they see Procter & Gamble as a safe bet when things are a little rocky.
Makes sense. It's like paying a bit more for a brand you really trust, even when there are cheaper options.
That's a perfect way to put it. And their PEG ratio, which takes into account future growth, is likely to be within a reasonable range, especially since they're known for steady, even if it's moderate, growth.
So they're not necessarily going to double in value overnight, but they're going to deliver consistent results year after year.
Yeah.
So what's their outlook for the rest of fiscal year 2025?
They're projecting all-in sales growth of 2 to 4% and organic sales growth of 3 to 5%. And they're expecting a 10 to 12% increase in their GAAP earnings per share.
That's good news for investors. And let's not forget their dividend history. 134 years of paying dividends, and they've increased those payments for 66 years straight.
Right, their current dividend yield is about 2.37%. That's really attractive for investors who are looking for stability, especially in a market that's all over the place.
So it's all about that peace of mind, right?
Exactly.
Now, no company is completely immune to risk. What are some of the challenges that Procter & Gamble might face going forward?
Well, like a lot of global companies, they're exposed to fluctuations in currency exchange rates, and those rising costs for materials could impact their profits. But their diverse product portfolio and the fact they're all over the world helps to balance those
It's
risks.
all about spreading the risk, right?
Right, exactly. And their commitment to giving back to shareholders is another plus. They're planning to return $16 to $17 billion to shareholders in fiscal year 2025, $10 billion in dividends, and $6 to $7 billion through share buybacks.
That's a company that clearly values its shareholders. All right, speaking of things that make us feel good, let's move on to Coca-Cola, ticker symbol COK. I mean, it's another iconic brand, one that's in just about everyone's home.
Yeah, for sure.
So what makes this beverage giant so resilient, especially in a bear market?
Coca-Cola is all about consistency and brand loyalty, really. Their performance in 2024 showed they can handle whatever's thrown at them. They had a comparable EPS of $2.88 for the entire year, showing how consistently profitable they are.
It's like their secret formula for earnings is just as closely guarded as the recipe for Coke itself.
Exactly. And their revenue growth is pretty impressive, too. In the fourth quarter of 2024, they had a 6% increase, bringing in a whopping $11.54 billion. That's even more than the analysts were expecting. A big part of their organic revenue growth comes from that diverse range of drinks they offer.
Okay, let's talk numbers. Right now, Coca-Cola is trading at a forward PE ratio of about 23.7 times earnings based on their projected 2025 EPS. So what's your take on that?
That's a pretty fair valuation for a global leader like them, especially when you consider their consistent dividends and how strong their position is in the beverage industry. Now, we don't have an exact PEG ratio, but based on their projected EPS growth and that forward PE, we can estimate it's probably somewhere between 2.37 and 2.96.
So what's that telling us about Coca-Cola's potential for growth, considering their PEG ratio is a little bit above 1?
Well, it might suggest that their stock is a tad overvalued, but we can't forget about those defensive characteristics and reliable dividends. Their consistency and dependability are more important factors than, expecting explosive growth.
Got it. So they're not necessarily going to double in value overnight, but they're going to offer stability and a steady stream of income, which is super valuable in a bear market.
Exactly. And speaking of looking ahead, they're projecting some pretty solid numbers for 2025. They're forecasting organic revenue growth of 5 to 6%, and their comparable EPS is expected to grow by 2 to 3%, reaching an estimated $2.95 per share. But they are taking into account a currency headwind of 6 to 7%.
So even with those currency challenges, their core business is still performing well.
Exactly. And financially, Coca-Cola is in a really strong position. They have a really solid balance sheet, and they generate a lot of cash, which allows them to manage their debt and stay financially healthy.
It's like they're built to go the distance. But how about their risk profile? How are they positioned to handle those potential economic downturns?
Well, like we talked about earlier, they're in the consumer staples sector. And this sector is known for being resilient during those downturns. People still need their drinks even when they're cutting back in other areas. So Coca-Cola is not as exposed to that economic volatility. They've also increased their dividend payments for 63 years straight, earning them the title of Dividend King.
That's an impressive track record of taking care of their shareholders. Okay, so let's turn our attention to a company that's become a household name, especially in the last few years. Pfizer, ticker symbol PFE.
Oh, yeah.
So what do you think about them?
Pfizer's all about innovation. Their full year 2024 results are pretty amazing. They reported an EPS of $1.42, which is a massive 276% increase from their 2023 EPS of 38 cents. That's a comeback story if I ever heard one.
Talk about bouncing back.
Yeah.
It's incredible how they were able to thrive even with the challenges that hit the pharmaceutical industry after the pandemic.
Absolutely. And if we look at their fourth quarter 2024 performance, it's even more impressive. They reported an EPS of 93 cents, a 47% increase from the previous year, and beating analyst expectations.
They're not just meeting expectations, they're blowing them out of the water. And what about their revenue growth? Are they continuing to build on that momentum?
Absolutely. Their full year 2024 revenue reached $63.6 billion. That's an 8.8% increase from the previous year. This growth shows they're expanding and diversifying even as we move past the peak of the COVID-19 pandemic. Their fourth quarter 2024 revenue saw a 22% increase, bringing in $17.76 billion, driven by their COVID-19 products and their recent acquisition of Seagen.
Speaking of Seagen, that was a big move. Can you tell us more about why they went for that acquisition and what it means for their future?
Pfizer's acquisition of Seagen was a strategic move to strengthen their oncology portfolio. This helps them diversify their revenue and get ready for a potential decline in those COVID-related sales. They're not just sitting back, they're actively finding ways to adapt to the changing market.
That's a really important point for investors. It's not just about past performance, it's about understanding a company's strategy for the future. Now, I know a lot of investors look at the P/E ratio when they're trying to figure out how much a company is worth. What's Pfizer's P/E ratio looking like these days?
Right now, it's at 35.02. Might seem high compared to other industries, but it's pretty common in the pharmaceutical world. Investors often factor in potential growth and the fact that these companies invest a lot in research and development when they're evaluating them.
So it's not necessarily a bad sign, but something to keep in mind when you're comparing them to companies in other sectors.
Exactly. We don't have an exact PEG ratio, but considering their revenue growth, it likely adjusts their PE downwards, which makes them look a bit more attractive from a valuation perspective.
Okay, so growth potential is a big part of their story. What are the key things they're focusing on to drive that future growth?
Well, their guidance for 2025 predicts revenue between $61 and $64 billion. It might seem like a slight dip from 2024, but their estimated adjusted EPS, which is expected to be between $2.80 and $3 per share, tells a different story. Basically, their overall revenue might stay about the same, but their profitability is going up, and that's good for investors.
It's not just about how much money they bring in, it's about how efficiently they turn that revenue into profit, right?
Absolutely. And if we look even further ahead, they're expecting a 6% compound annual growth rate from 2025 to 2030. They're counting on new product launches and developments in their research pipeline to fuel this growth, especially in areas like inflammation and immunology, which are expected to grow a lot.
So they're constantly innovating and finding ways to stay ahead in the pharmaceutical industry.
That's the key to success in this sector. Specifically, key products like Vyndaqel, Eliquis, and Xtandi are expected to be major growth drivers, and we can't forget the contributions from their oncology portfolio, which got a boost from the Seagen acquisition.
So they're setting themselves up for long-term growth. What about their financial health? Are they managing their money well?
Oh, absolutely. They've been really proactive. They've used their strong cash flow to fund those strategic acquisitions, increase their dividends, buy back their own shares, and reduce their debt.
That's what I call financial discipline, and it shows in their strong balance sheet. What about their dividend? Are they sharing those profits with their shareholders?
Oh, yeah, definitely. Their current dividend yield is a pretty generous 6.51%, which shows just how strong they are financially and how committed they are to rewarding their shareholders.
That's definitely appealing, especially with interest rates being so low these days. Now, of course, no investment is completely risk-free. So what are some potential challenges Pfizer might face in the future?
Like any pharmaceutical company, they have to worry about patents expiring. For example, their blockbuster drug, Keytruda, is going to lose patent protection in Europe by 2031. That could have an impact on their revenue.
So the clock is ticking on that exclusivity in Europe. How are they preparing for that?
They're putting a lot of effort into developing new drugs that can take over when Keytruda's patent runs out. They're also exploring new treatment methods like gene therapy and RNA-based therapies, which could lead to breakthroughs in treating rare diseases and personalized medicine.
It sounds like they're not just waiting for the patent to expire. They're proactively looking for ways to stay ahead of the game.
Exactly. Another challenge is the increasing scrutiny of drug prices. Governments and insurance companies are pushing back against high drug costs, and that could squeeze Pfizer's profit margins.
That's a legitimate concern. So how are they dealing with that?
They're working on showing the value of their medications and making them more accessible through patient assistance programs and other initiatives. They're also looking into new pricing models that link the price of a drug to how well it works.
So they're being proactive about that.
Yeah, they are. And they're also facing competition from companies making generic drugs who are always trying to make cheaper versions of their medications.
It's a constant race in the pharmaceutical industry to innovate and stay ahead of the competition. Now, we've been focusing on the risks, but overall, Pfizer seems like it's in a good position, don't you think?
Definitely. Their finances are solid, they're committed to shareholder value through those dividends, and they have a proactive approach to growth.
Let's move on from pharmaceuticals and talk about telecommunications with Verizon, ticker symbol VZ. They provide essential services, right?
Right.
So what makes them a potential safe haven during a bear market?
Verizon, like many telecom companies, provides something that's become essential these days. Even when times are tough, people need to stay connected, and Verizon's network is vital for millions of customers.
They're like the modern-day equivalent of a utility company, right?
Exactly. And you can see that stability reflected in their recent earnings performance. Back in 2022, they reported an EPS of $5.06. And even though it dipped in 2023, they came back strong in 2024 with an EPS of $4.15, beating analysts' estimates.
So they stumbled a bit, but got back on track quickly.
Right.
That's got to be good for investors looking for a company that can handle the market's ups and downs.
Definitely. And they've consistently exceeded those consensus estimates over the past 4 quarters, which tells me they're running their business well.
Consistency is key, especially when things are a bit unpredictable. How about their revenue growth? Is that showing a similar trend?
Their full year 2024 revenue came in at $134.8 billion, pretty much flat compared to last year. But in the fourth quarter of 2024, they saw a 1.6% increase year over year, with revenue reaching $35.68 billion. And they're estimating revenue of $33.46 billion for this quarter, which would be a 1.4% increase year over year.
So there are signs of growth, even if it's not super fast.
Right.
They're playing the long game.
Yeah, I like that. Their projections for the whole fiscal year are similar. They're expecting $136.75 billion in revenue for this fiscal year, a 1.5% increase, and $139.9 billion for the next fiscal year, a 2.3% increase.
So slow and steady wins the race. Now, what about their valuation? Are they a good buy at their current price?
We don't have an exact PE ratio readily available, but based on their past stock price and their 2024 EPS, we can estimate it's probably around 8.9. If you compare that to the S&P 500's PE ratio, which is currently around 30.3, you can see Verizon is trading at a significant discount.
So they could be a good deal for investors looking for value.
Exactly. And while we don't have their exact PEG ratio, considering their EPS growth projections, it's likely in a reasonable range.
So their fundamentals are strong, and they're in a defensive sector.
Right.
All right, let's dig a little deeper into their financials.
Okay.
Their net income for 2024 was a whopping $17.5 billion. That's a 51% increase year over year. And their profit margin jumped up to 13% in 2024 from 8.7% in 2023.
Wow, that's a big improvement in profitability.
What's driving that?
Well, it's a few things. They're focused on managing costs, their strategic pricing is working, and their investments in 5G are starting to pay off.
So they're becoming more efficient and generating more profit.
Let's talk about cash flow, because that's ultimately what fuels those dividends that investors love.
Their free cash flow year-to-date is already at $14.5 billion, which is more than enough to cover those dividend payments of $8.4 billion. So they're generating plenty of cash to keep those dividends going and still have room to invest in growth. So they're in a good position to keep those dividends coming. But what about the risks? Are there any red flags investors should be aware of?
Well, like any company, they have their risks. The FCC is looking into their diversity practices, which could hurt their reputation, but there's no sign yet that it'll impact them financially.
Okay, so it's something to watch.
Right, exactly. And they're also acquiring Frontier Communications, a move to increase their market share and improve their network. Acquisitions always have risks, but if they do it right, it could be a big boost for Verizon.
So some bumps along the way, but overall, they seem to be a solid company with a good future. What do you think?
Absolutely. They're defensive, they have a good dividend history, and they're focused on innovation. I think that sets them up well for success.
All right, let's move on to a company that knows all about value and resilience. Walmart, ticker symbol WMT. I mean, who hasn't shopped at a Walmart at some point?
Walmart is a giant. They've been a part of the American economy for decades. And it's really impressive how they've adapted to the changes in retail, especially with online shopping becoming so big.
They've really evolved, haven't they?
Yeah.
And their recent performance shows they're doing things right. For their fiscal year 2025, which ended on January 31st, 2025, they had an adjusted EPS of 66 cents for the fourth quarter. That was better than what analysts were expecting. And for the whole year, their estimated adjusted EPS is around $2.74.
That's impressive considering all the economic challenges they've faced.
It's like they're sailing through a storm and coming out even stronger.
Right.
And their revenue growth is impressive, too. In the fourth quarter of 2025, they brought in a staggering $180.55 billion in revenue, a 5.2% increase year over year. It's hard to believe how much money they make. What's the key to their success?
It's a mix of things. They're huge, they're laser focused on keeping prices low, and they've been smart about expanding into e-commerce. They're making sure they're where the customers are, both online and in their stores.
They're not just a retailer anymore, are they? They're becoming a one-stop shop.
Yeah, exactly.
And they hit a record revenue of $681 billion for the whole fiscal year 2025, a 5.7% increase from the previous year. That's huge.
It shows they know how to carry out their plans and adapt to how people shop. They're not just keeping up, they're leading the way.
Okay, so their earnings and revenue are growing, but are they a good value for the price?
Well, their PE ratio as of March 8th, 2025, is around 38, which is pretty high compared to their historical averages. It means the market's expecting continued strong growth, and that expectation is built into the stock price.
So some investors might be worried the stock is getting a little ahead of itself.
That's a fair point, and it's always good to consider different perspectives. Some analysts believe the stock is a bit overvalued right now, but others are more optimistic about their long-term potential.
So as with any investment, it depends on how much risk you're comfortable with and what your goals are. What about their PEG ratio, the one that considers future growth?
Right now, it's estimated to be between 3 and 3.5, which is a bit high. It suggests the stock might not be a bargain, but it's important to remember that Walmart's real strength is in its stability and its ability to perform well even when the economy isn't doing so great.
Okay, so maybe not a super cheap buy, but their track record of resilience is a definite plus.
Absolutely. And their guidance for fiscal year 2026 is a bit more conservative than some people were hoping for. They're projecting EPS to be between $2.50 and $2.60, and revenue growth to be in the 3 to 4% range.
So they're not expecting massive growth, but they're still expecting to expand. What are some of the factors that might be behind this more cautious outlook?
They're dealing with some challenges like inflation that just won't quit, potential tariffs under the current administration's trade policies, and the fact that the US dollar is so strong. All of these things could affect their profits and make it harder to reach those higher growth rates.
So they're dealing with a lot of moving parts in the economy, but they've got a history of overcoming challenges.
Exactly. And the main things driving their growth are still there. Their e-commerce business is still growing strong. They're taking market share in important categories like groceries, and they're always coming up with new ways to improve their operations and the customer experience.
They're a well-oiled machine, aren't they?
They really are.
Let's talk about their financial health. That's super important for any long-term investment.
Absolutely. Strong financials are the foundation of a successful company. So, what are some key things we should be looking at?
I'm glad you asked.
Well, their debt-to-equity ratio is about 0.6, which means they're using a moderate amount of leverage. That's very manageable for a company as big as Walmart. Their current ratio, which tells us how easily they can pay their short-term bills, is around 0.9.
Now, it's a little below 1, which might make some people nervous, but it's not unusual for retail companies that have a lot of inventory.
You're right. We have to consider industry standards when we look at these ratios. And Walmart's cash flow is really strong. They make between $35 and $40 billion in operating cash flow every year. That gives them a lot of options for investing in growth, paying dividends, and buying back their own stock.
They're a cash-generating machine, and their net profit for their fiscal year 2025 was a record $20.1 billion. So they're not just growing, they're becoming more profitable.
Exactly. They're proving that they can operate efficiently and effectively, which is so important in today's competitive world.
Now, every investment has some risks, right? What are the main risks that investors should be thinking about when it comes to Walmart?
Well, like we said before, tariffs are a potential problem. The current administration's trade policies could make things that are imported from China more expensive, and that could hurt Walmart's profits.
Yeah, those trade wars have been a bit of a wild card.
They have. But Walmart is so big that they have a lot of power when it comes to negotiating with suppliers, so they're in a better position to handle that risk than a lot of other companies. They could even find different suppliers in other parts of the world if they had to.
So their size is actually a good thing in this case.
Exactly. They've got more options. Now, another risk is the overall health of the economy. Even though Walmart is a resilient company, they're not completely immune to recessions. If people start cutting back on their spending, it could hurt their sales, especially in those non-essential categories like electronics and clothing.
Right, people might still buy their groceries at Walmart, but they might put off buying that new TV or that expensive pair of shoes if they're worried about money.
Exactly. But overall, Walmart is a relatively safe bet. They're in good financial shape, they generate a lot of cash, and they're well managed.
Okay, so they're not risk-free, but they're a solid choice, especially when the market is a bit shaky.
I agree. They've shown time and time again that they can handle the ups and downs of the economy and come out on top.
All right, let's switch gears and talk about a company that's been doing really well lately. AbbVie, ticker symbol ABBV. They're a global biopharmaceutical company that focuses on immunology.
AbbVie is a really interesting company. They've been able to keep growing even though they're losing patent protection for their top-selling drug, Humira. They've managed to do this by developing new blockbuster drugs and making their portfolio more diverse.
So they're not just relying on one drug to carry them through, they're investing in their future. What were some of their big accomplishments in 2024?
Well, their adjusted EPS for 2024 was $10.12. That's pretty amazing when you consider they had a big impairment charge in the fourth quarter.
Impairment charge. That doesn't sound good. What's that all about?
It's basically a one-time accounting adjustment that happens when an asset loses value. In this case, it was a $3.5 billion charge because of their acquisition of Cerevel Therapeutics. It did affect their fourth quarter results, but it doesn't necessarily mean anything bad about their overall financial health.
So it's just a temporary setback.
Yeah, exactly.
Oh.
And their fourth quarter 2024 adjusted EPS, even with that impairment charge, was still $2.16. Their performance for the year shows they can handle challenges and still deliver strong earnings.
That's definitely reassuring. And their revenue growth is worth noting, too.
Yeah.
In the fourth quarter of 2024, their revenue was $15.1 billion, a 5.6% increase year over year. They're clearly growing and expanding their business, even in this unpredictable economy.
Absolutely. And when you look at where that revenue is coming from, it's obvious that their immunology portfolio is what's driving their success. Their drugs, Skyrizi and Rinvoq, generated incredible sales, $17.7 billion combined in 2024.
Wow, $17.7 billion from just 2 drugs. They've definitely found a winning formula. What are they expecting for the future?
Well, they're predicting high single-digit revenue growth through 2029, which tells us they've got a strong pipeline and a clear strategy.
So they're not just a one-hit wonder. They have a plan for continued success.
Exactly. And they're also expanding Rinvoq into 5 new areas, including giant cell arthritis and alopecia areata. Those are big market opportunities that could drive their growth for years to come.
Okay, so they're diversifying, expanding into new markets, and continuing to innovate. That sounds like a recipe for success. But what makes AbbVie a particularly good bet for a bear market? What are the key things that make them stand out?
First of all, they're in the healthcare sector, which is known for being resilient during economic downturns. People need medical treatments no matter what the economy is doing, so the demand for AbbVie's products is likely to remain pretty stable even during a recession.
It's like they're providing a service that's always going to be in demand.
Exactly. And their stock price doesn't fluctuate much either. Their beta is just 0.11. This means that their stock price tends to move less dramatically than the overall market, so it's a smoother ride for investors.
Okay, so they're in a defensive sector, they have low volatility, and they pay a solid dividend, it sounds like.
It sounds like they've got all the bases covered for weathering a bear market. But of course, no investment is completely risk-free. Are there any potential risks or challenges investors should be aware of?
That's always a good question to ask. So what are some things that could trip them up?
Well, like with any pharmaceutical company, there's always a chance the regulations could change or that something unexpected happens in their research and development pipeline. And the market they're in is very competitive, so they need to keep innovating and staying ahead of the game to keep their market share. Plus, there's always the possibility of unforeseen events, like those legal settlements or impairment charges we talked about.
Okay, so there are always bumps in the road, but it sounds like AbbVie is pretty well equipped to handle them.
I think so. They have a strong management team, their finances are solid, and they have a history of success. I definitely say they're a company worth considering, especially for investors who are looking for a balance of growth and stability.
Makes sense. They seem to be navigating the pharmaceutical industry pretty well. Speaking of navigating challenges, let's move on to another company that's been really good at adapting to change. Mondelez International, ticker symbol MDLZ. I bet you've got some of their products in your pantry right now.
Probably. Everyone loves a good snack. They're the company behind all those iconic brands. Oreo, Cadbury, Ritz, Trident. Their recent performance shows they're not just tasty treats, they're a solid investment, especially during a bear market.
The perfect combination of indulgence and stability. Let's start with their earnings. In the fourth quarter of 2024, which they reported on February 4th, 2025, they earned 65 cents per share. Now, that was a little below what analysts were expecting, which was 66 cents. But their third quarter 2024 earnings were much stronger, with 99 cents per share adjusted. That was 16.6% higher than what analysts were predicting.
It's encouraging to see those positive surprises even when things are tough. And if you look at their trailing 12-month earnings per share, it's currently at $3.31.
Okay, so their earnings track record looks pretty good. How about revenue growth? Are they still growing that snacking empire?
They are. In the fourth quarter of 2024, their revenue was $9.2 billion. That's a 1.9% increase year over year. But it's important to keep in mind that things like the rising cost of cocoa can affect their profits.
Yeah, those rising commodity prices have been a problem for a lot of companies. But even with those challenges, they're still growing. What's their estimated growth rate over the next few years?
Their estimated 3-year compound annual growth rate for revenue is expected to be between 8 and 10%. That's pretty impressive given all the uncertainty in the global economy right now.
Okay, so growth looks promising. But what about their value? Are they a good buy at their current price?
Their trailing PE ratio as of March 3rd, 2025 is 18.79. That's a bit lower than the average for the consumer staples sector, which is usually between 20 and 25.
So that suggests they might actually be undervalued compared to their peers, which could be a good opportunity for investors who are looking for value.
Exactly. And their forward PE ratio, based on what analysts are predicting for their earnings, is 21.83. That means the market is anticipating growth, but they're not putting a huge premium on it.
Got it. So the growth expectations are reasonable. What about their PEG ratio? How does that fit into the picture?
This is where things get interesting. Their PEG ratio as of March 3rd is 4.34, which is pretty high. A high PEG ratio usually means that a stock is overvalued compared to how much its earnings are expected to grow.
So does that mean we should be cautious about investing in Mondelez?
Not necessarily. While a high PEG ratio can be a warning sign, you always have to look at the context. In this case, it could also mean that the analysts are being a little too conservative with their growth estimates. Some analysts are projecting high single-digit EPS growth, and if that happens, it would bring their PEG ratio down quite a bit, making them look more attractive.
So it's a sign to do a little more research and not just rely on one metric.
Yeah.
What are some of the things that could drive that higher EPS growth?
Mondelez has a few things going for them. Analysts are predicting EPS growth of 8 to 10% per year, and this is expected to be driven by things like cost management, making their products more premium, and strategically expanding into emerging markets.
Sounds like they've got a lot going on. But can their free cash flow support all of these plans and those dividends?
Absolutely. They're projected to generate more than $3.5 billion in free cash flow in 2025, which shows how strong their operations are. This cash flow gives them the flexibility to pay dividends, buy back shares, and invest in developing new products and marketing.
They're a cash-generating machine.
Hmm.
And they're also planning to buy back $9 billion worth of their stock by 2027. That's a big vote of confidence in their future.
It really is. It suggests they think their stock is undervalued and they're taking advantage of that. And it's not just the company itself. Analysts have given the stock a consensus rating of moderate buy, with the target price of $69.74. That's about 8 to 10% higher than where it is now.
Okay, so they've got the potential for growth, strong cash flow, and the analysts are on board. What about their overall financial health? Are they in good shape to handle any bumps in the road?
They are. Their net margin for the fourth quarter of 2024 was 12.68%, which means they're profitable even with those rising cocoa costs. Their return on equity is 17.75%, which is healthy. We don't have their exact debt numbers, but analysts say their debt-to-equity ratio is manageable and their balance sheet is considered strong.
So no red flags there. But every investment has some risk. What are some potential challenges Mondelez might face?
Well, those cocoa prices are unpredictable. If they keep going up, it could squeeze their profit margins and hurt their earnings. And being a global company, they're exposed to changes in currency exchange rates and any political or economic instability in the places where they do business.
That makes sense. And let's not forget about the competition in the snack food industry. Companies like Hershey are always trying to get a bigger piece of the market.
That's true. But Mondelez has a few things working in their favor. They're proactive about managing their supply chain, which helps them deal with those fluctuating commodity prices. And because they have such iconic brands, they have some control over their pricing. They can pass some of those increased costs on to the consumer without losing too much market share.
So they're not just crossing their fingers and hoping for the best. They're actively managing those risks. Now, stepping back a bit, why is Mondelez a good pick for a bear market portfolio?
The biggest reason is that they're in the consumer staples sector, which tends to do well during economic downturns. People might cut back on big purchases, but they still want those little indulgences, like their favorite snacks, especially when times are tough.
I know, I turn to chocolate when I'm stressed. So those comfort purchases could actually help them during a recession. What about their dividend? Is that something that income investors might like?
Absolutely. Their annual dividend yield is 3.2%, which is pretty decent. It offers a steady stream of passive income, especially when other investments might be struggling.
And they have a history of increasing their dividends, which shows they care about their shareholders. How volatile is their stock?
Their beta, as of March 3rd, 2025, is only 0.54, which means they're a lot less volatile than the overall market. So their stock price isn't likely to experience those big swings that can make investors nervous during a bear market.
So they're a calming presence in a turbulent market.
I like that analogy. And while their stock price has been trading below its 50-day and 200-day moving averages since October 2024, their low beta suggests they're unlikely to experience those big drops that some other stocks might face.
So they're a steady performer, even when things get shaky.
Exactly. And some analysts think they're undervalued right now, with a fair value estimated around $71.35 compared to their current price of $64.25.
So there's potential for growth there, especially with that $9 billion share buyback program they've got going on. What does that buyback program, combined with their dividends, mean for investors in terms of potential returns?
Some analysts are estimating that it could lead to a total shareholder yield of about 7% per year.
That's a number investors can get behind. Before we move on, what's been happening with Mondelez lately? Anything investors should know about?
Their fourth quarter 2024 earnings report, which came out on February 4th, 2025, made some headlines. They missed earnings expectations by a tiny bit, but they met revenue expectations. They also talked about how they're handling those rising cocoa costs.
So they're facing those challenges head-on and finding ways to stay profitable.
Exactly. And analysts at the Royal Bank of Canada recently lowered their price target from $75 to $69, but they kept their outperform rating.
So they're still optimistic about Mondelez, even with that slight adjustment to the price target.
Yeah. And there were even some rumors back in December 2024 about them possibly acquiring Hershey. It was reported that Mondelez was thinking about making a takeover bid, which would create a huge confectionery giant.
Yeah, that would definitely shake things up in the snack food industry. Did anything ever come of those rumors?
Hershey's stock jumped almost 11% on the news, but Mondelez's stock stayed pretty steady, which suggests that the market was more focused on how it would impact Hershey. There haven't been any real developments since then, so it's all just speculation right now, but it's definitely something to keep an eye on.
A potential mega merger, rising cocoa costs, a new dividend payout, and a portfolio of iconic brands. Mondelez always keeps things interesting. They're definitely a company that's always moving.
They are. They're always innovating and adapting to stay ahead of the game. That's a good sign for their future.
All right, let's switch gears to another pharmaceutical giant that's been in the news lately. Merck & Co., ticker symbol MRK. They're known for their cancer drug, Keytruda, but they're also facing some challenges as they get ready for that drug to eventually lose its patent protection.
Merck has a long history of innovation. They're in a bit of a transition right now as they prepare for Keytruda's patent to expire in Europe in 2031.
Keytruda has been a huge success for them, hasn't it?
It has. It's been a big driver of their revenue, but because that patent is going to expire soon, they're working hard to diversify their portfolio and find new sources of revenue. They're not putting all their eggs in one basket.
That's good to hear. What does their recent financial performance tell us about their progress?
Well, their EPS for 2024 was $6.74. That's a pretty remarkable turnaround from their 2023 EPS of just 14 cents.
Wow, that's a huge jump. What led to that?
Their profit margin went up to 27% in 2024, a big increase from just 0.6% in 2023. This shows that they're doing a good job of managing their costs and becoming more efficient.
So they're making more money from every dollar they earn. That's good news for investors. How about their revenue growth? Are they seeing positive momentum there too?
Absolutely. Their revenue for 2024 was $64.2 billion, which is a 6.7% increase from the year before.
Okay, so they're growing their revenue and becoming more profitable. That's a great combination. What does their PE ratio look like?
Right now, their PE ratio is about 10.05, based on their projected ETS for 2025 of $9.01 and their current stock price. This is quite a bit lower than the industry average of 12.89.
That seems really low, especially compared to some of the other companies we've talked about. Could this be a good time for value investors to buy?
It's definitely something to think about. Their stock price has dropped about 36% since it peaked in March 2024, which is part of the reason why their PE ratio is so low. But their fundamentals are still strong.
So it could be a dip to buy. What about their PEG ratio? Does that support the idea that Merck might be undervalued?
Yes, their PEG ratio is currently 0.79, which suggests that they might be undervalued based on their future growth potential.
That's a good sign for potential investors. But are they just coasting on the success of Keytruda, or are they actively trying to diversify and develop new products?
They're definitely not just sitting back and relaxing. Analysts are predicting that their EPS for 2025 will be $9.01, which would be an amazing 33.7% increase from 2024. They're not relying solely on Keytruda. Their animal health business is growing, and they've got some new products coming out soon.
Okay, so they have multiple avenues for growth. It sounds like they're taking a well-rounded approach.
Exactly. They've also been acquiring companies strategically to strengthen their portfolio. For example, they recently bought Lenova Medicines, which specializes in immunotherapy, a promising area for cancer treatment.
So they're investing in innovation and staying ahead of the game.
Mm-hmm.
What are some of the challenges they're facing?
Well, they're having some trouble in China, where sales of their Gardasil vaccine have been declining, but they're confident that growth in other areas will make up for those losses.
And so it's a balancing act, but their overall growth prospects look pretty good.
They do. And their financial health is in good shape, too. Their profit margin has improved a lot, and they're generating around $17 billion in free cash flow each year. That gives them a lot of flexibility. Their debt levels are moderate, with a debt-to-equity ratio of about 0.5.
So they're in a good position to handle any economic turbulence. But as with any investment, there are risks. What are some of the key risks to keep in mind with Merck?
Like any pharmaceutical company, they face the risk of being too reliant on blockbuster drugs. Right now, Keytruda accounts for about 50% of their revenue. If anything were to happen to disrupt that, like unexpected side effects or a competitor coming out with a better drug, it could really hurt their bottom line. And the fact that Keytruda's patent is going to expire in Europe soon adds to that concern.
So that dependence on Keytruda is a valid concern. But they're aware of it, right? They're not just ignoring the issue.
Absolutely not. They're working on mitigating that risk. They have a history of successfully replacing their older blockbuster drugs with new ones. Remember, they got Keytruda when they acquired Schering-Plough back in 2009.
So they've shown they can innovate and adapt.
Exactly. Another risk is their exposure to the Chinese market, especially with the slowdown in Gardasil sales. But as a global company with a diverse portfolio, they're not overly dependent on any single market or product.
So they're diversified enough to handle some bumps along the way.
That's right. While there are risks, their overall risk profile seems manageable.
Now let's talk about why Merck is a good option for a bear market.
Well, the biggest reason is that they're a healthcare company, and healthcare companies tend to do well during economic downturns. As we've said before, people still need medications and treatments even when the economy is bad.
It's a sector that doesn't really go through cycles. People always need healthcare.
That's right. And Merck's valuation, with that low PE and PEG ratio, makes them even more attractive in a bear market. Investors are always looking for bargains during those times, and Merck, at its current price, could be a steal.
It's like finding a designer dress at a thrift store.
Hmm.
And their dividend is another plus, right?
Definitely. Their annual dividend is $3.24 per share, which gives a yield of about 3.5%.
That's a pretty good yield, especially when it might be harder to make money from capital gains in a bear market.
Exactly. That consistent income stream can be a big help when the market is all over the place.
So we've got a company in a defensive sector with a low valuation and a good dividend yield. Sounds like a good pick for a bear market.
It does. And there's been some interesting news about Merck lately, both good and bad, which is normal for the pharmaceutical industry. They've had some quarters that weren't so great, which is part of why their stock price has gone down. But they've also had some wins, like the acquisition of Lenova Medicines and the fact that some insiders have been buying their stock.
So there's some uncertainty, but it sounds like their strengths are outweighing the concerns. What should investors be watching for with Merck in the coming months?
It'll be interesting to see how their new products perform and how they handle the transition away from Keytruda. Their performance in China will also be worth watching, as well as any legal or regulatory issues that might come up.
Okay, so there's a lot going on with Merck. But they're a company with a lot of potential, especially for investors who are looking for a company with a history of innovation and a good track record of handling challenges.
I agree. They're innovators, they're adaptable, and they're committed to delivering value to their shareholders. I think they're worth considering for any well-rounded portfolio.
All right, let's move on to a company that's been connecting people for over 100 years, AT&T, ticker symbol T. They're a telecommunications giant that's seen a lot of changes in recent years, but they're still a big player in the industry.
AT&T has gone through a lot of changes, but they're still in a strong position. And they have a lot of qualities that make them attractive for a bear market.
They're like the wise old owl of the telecom world, aren't they? They've seen it all.
Exactly. And their recent earnings show they can still deliver. In the fourth quarter of 2024, their EPS was 54 cents, which was better than the 50 cents that analysts were expecting. And for the whole year, their adjusted EPS was $1.49.
Okay, so maybe their growth isn't explosive, but consistently beating expectations is definitely a positive sign. How about their revenue? How have they been doing on that front?
It's important to remember the challenges they've faced in recent years, like rising operating expenses, a telecom market that's not growing as fast as it used to, and the fact that they sold off some of their media assets, like Warner Media. It's important to keep all of that in mind when we look at their revenue trends.
So they've been streamlining their business to stay competitive.
Exactly. For the full year 2024, their revenue was $122.3 billion, which is a little bit lower than the year before. However, their revenue in the fourth quarter of 2024 actually went up a little bit, reaching $32.3 billion. That's a 0.9% increase year over year.
So some signs of growth there, even with all the challenges.
Right.
They're hanging in there.
They are, and they're predicting low single-digit consolidated service revenue growth for 2025, with stronger growth expected in their mobility and consumer fiber segments.
So some areas of their business are growing, especially those that are becoming more and more important in our digital world.
Exactly. Now let's talk about their financial health. Can they handle a potential recession?
That's the million-dollar question, isn't it? What do their financials tell us?
Well, they have a lot of debt, about $122 billion, but it's down 10% from 2 years ago, which shows they're making progress in reducing that debt.
Okay, so their debt is something to keep an eye on, but at least they're taking steps to address it.
Exactly. They're working on improving their balance sheet. And their free cash flow is really good. It's more than $16 billion a year. That allows them to cover their dividend payments, which are currently about $8 billion a year, and still have money left over to pay down debt. Their free cash flow dividend payout ratio is about 50%, which is considered very sustainable.
So their dividend is well covered by their cash flow. That's a good sign for income investors.
Yes, their dividend is a big attraction for a lot of investors.
Now, they've had their ups and downs over the years, but overall, their financial position seems pretty solid.
I agree. They're making progress in strengthening their financial position. But it's important to be aware of the risks. Their high debt level could make it harder for them to invest in new growth opportunities or make acquisitions in the future. They also have a lot of competition from companies like T-Mobile and Verizon. And of course, there's always the risk that the government could make changes that affect their business.
Those are all valid points.
No.
But even with those risks, AT&T has some appealing qualities for investors who are looking for bear market investments.
Absolutely. They're a telecommunications provider, which means they're in a defensive sector. People need their phones and their internet no matter what's happening in the economy. So the demand for AT&T's services should stay pretty stable even during a recession.
It's like they're selling an essential service. People might cut back on other things, but staying connected is a top priority for most people.
Exactly. And their dividend is another big draw. Their dividend yield is currently around 5%, which is a lot higher than the average for the S&P 500.
So a nice, juicy dividend yield, which is what income investors want to hear, especially when capital gains might be harder to come by in a bear market.
Exactly. That consistent income stream can make a big difference when the market is volatile. And their low volatility is another plus. Their beta is about 0.6, which is significantly lower than the market as a whole.
So they're not going to experience those wild price swings that can make investors feel like they're on a roller coaster.
Right. They're a much smoother, more predictable investment. And their valuation, with that lower PE ratio, makes them even more appealing.
So they check all the boxes for a good bear market investment defensive sector, high dividend yield, low volatility, and a good valuation. Sounds like a solid choice.
It does. Now, before we move on, I wanted to mention a couple of recent news items that might be interesting to investors.
Okay, what's been happening with AT&T lately?
Well, on March 4th, 2025, their stock price dropped 2.4% after their CEO spoke at a Morgan Stanley conference. He said that they had fewer new subscribers in January, which is usually a slow month for the industry. But he was optimistic about increasing their average revenue per user by raising prices and improving their business wireline segment.
So kind of a mixed bag of news. Do you think the market overreacted?
Maybe. Just a few days before that, there were reports highlighting their strong performance in the fourth quarter, including a 70% increase in net income, good growth in 5G and fiber subscribers, and a projection of mid-teens growth in broadband for 2025.
So they're making progress in some key areas, but the market is still being cautious, which is understandable with a big established company like AT&T.
That's true. Their stock price might not be as volatile as some of those younger, faster-growing companies, but their stability and their dividend payouts can be very appealing, especially in a bear market.
All right, let's shift gears to another company that's practically synonymous with value and resilience. Walmart, ticker symbol WMT.
Ah, yes, Walmart. They're a giant in the retail world, and they've been a cornerstone of the American economy for decades. What's really impressive is how they've managed to adapt and thrive in a retail landscape that's always changing. They're always innovating, investing in technology, and expanding their online presence to stay ahead of the curve.
They're masters of recognizing change and adapting to it.
Exactly. And their recent performance proves that their strategies are working. For the fourth quarter of their fiscal year 2025, which ended January 31st, they reported an adjusted EPS of 66 cents, which was better than analysts were predicting. And for the whole year, they're estimated to have an adjusted EPS of about $2.74.
Those are some impressive numbers, especially when you consider all the inflation and supply chain problems that the retail industry has been dealing with.
They've managed to navigate through all of that and come out even stronger.
Absolutely. Their revenue growth is pretty remarkable, too. They had $180.5 billion in revenue in the fourth quarter, a 5.2% increase year over year. It's amazing how much money they make.
It is. Their success is a combination of things. Their massive scale, their focus on low prices, and their expansion into e-commerce, and even other areas like healthcare and financial services.
They're not just a store anymore. They're becoming a whole ecosystem.
Exactly. They're becoming a one-stop shop for everything. And they hit a record revenue of $681 billion for the full fiscal year 2025, which is a 5.7% increase from the previous year. It really shows how well they're executing their strategy and adapting to the changing ways that people shop.
It's impressive. Okay, so their earnings are growing, their revenue is growing, but are they a good value at their current price?
As of March 8th, 2025, their PE ratio is around 38, That's pretty high compared to their historical averages, which suggests that the market is expecting them to keep growing strongly, and that expectation is reflected in the stock price.
So some investors might be thinking that the stock is getting a little ahead of itself.
That's a valid concern. Some analysts do think the stock is slightly overvalued right now, but others are more optimistic about their long-term prospects. It really depends on your individual risk tolerance and what you're looking for in an investment.
What about their PEG ratio? How does that factor into the equation?
Right now, their PEG ratio is estimated to be between 3 and 3.5, which is on the high side. This could mean that the stock isn't a bargain relative to its growth rate. However, remember that Walmart's biggest strength is its stability and its ability to do well even in tough economic times.
Okay, so maybe not a steal, but their consistent performance and their resilience are appealing qualities.
Absolutely. And their guidance for fiscal year 2026 is a bit more conservative than some analysts were hoping for. They're projecting EPS to be somewhere between $2.50 and $2.60, and revenue growth to be in the 3 to 4% range.
So they're not expecting explosive growth, but they're still expecting to expand.
Right. They're facing some headwinds like inflation that just won't go away, potential tariffs from the current administration's trade policies, and the strong U.S. dollar. Those are all factors that could hurt their profits and make it harder to achieve those higher growth rates.
So they're dealing with a complex economic environment, but they have a history of overcoming challenges.
They do. And the things that are driving their growth are still strong. Their online business is growing, they're gaining market share in important categories like groceries, and they're constantly coming up with new ways to improve their operations and make their customers happy.
They're firing on all cylinders.
They are.
Okay, let's talk about their financial health.
Okay.
Their debt-to-equity ratio is about 0.6, which means they're using a moderate amount of debt. That's not a problem for a company as big as Walmart.
Yeah.
Their current ratio, which tells us how easily they can pay their short-term debts, is about 0.9.
That is a little bit below 1, which might worry some people. But it's pretty normal for retail companies that have a lot of inventory.
Yeah, that makes sense.
Yeah.
And their cash flow is incredibly strong. They generate between $35 and $40 billion in operating cash flow every year. That gives them a lot of room to invest in growth, pay dividends, and buy back their own stock.
Right. They generate a ton of cash. And their net profit for their fiscal year 2025 was a record $20.1 billion. So they're not just growing, they're also becoming more profitable, which is a great sign for long-term investors.
They're a profit machine. But every investment comes with risks. What are some of the key risks that investors should consider when it comes to Walmart?
Well, like we talked about before, tariffs are a potential concern. The current administration's trade policies could make those goods from China more expensive, which could hurt Walmart's profits. But because Walmart is so big, they have a lot of power when it comes to negotiating with their suppliers. So they're in a better position to handle that risk than a lot of other companies. They could even find different suppliers in other parts of the world if they had to.
So their size is actually an advantage in this case.
Exactly. It gives them more leverage and more options. Now, another risk is the overall health of the economy. Even though Walmart is a very resilient company, they're not totally immune to economic downturns. If people start spending less, it could affect their sales, especially in those discretionary categories like electronics and clothing.
Right. People might still buy their groceries at Walmart, but they might put off buying that new TV or those expensive shoes if they're worried about money.
Exactly.
Yeah.
But overall, I think Walmart is a relatively safe bet. They have a strong balance sheet, they generate a lot of cash, and they're very well managed. They're like a giant ship that can handle even the roughest storms.
So they're not risk-free, but they're a pretty solid choice, especially when the market is looking a bit volatile.
I agree. They've consistently shown that they can navigate those economic ups and downs.
All right, let's talk about why Walmart is such a strong choice during a bear market.
Well, one of the biggest reasons is that they're in the consumer staples sector. This sector tends to hold up well during economic downturns because people still need those basic necessities like food and household goods, even when they're cutting back in other areas.
They're the ultimate provider of necessities.
Exactly. And Walmart's low price model is another big advantage in a bear market. When people are watching their budgets, they tend to shop at places that offer the best deals. And Walmart is known for its low prices, which makes it a popular choice for budget-conscious shoppers.
They're the place to go when prices are going up everywhere else. And their track record during those past bear markets, like the pandemic in 2020 and the financial crisis in 2008, shows that their model works.
Absolutely. And their omni-channel strategy, combining those physical stores with a growing online presence, gives them an edge over traditional retailers and those online giants like Amazon.
They've really figured out how to blend the physical and the digital. Now let's talk about those dividends. They're a big draw for investors, especially when those capital gains might be harder to come by during a bear market. So what's the story with Walmart's dividends?
Right now, their annual dividend is 83 cents per share, and they just increased it by 9%, which marks their 51st year in a row of raising their dividend.
51 years straight, that's amazing.
It is. This makes them a dividend aristocrat, which is a group of companies that have increased their dividends for at least 25 years in a row. Their current dividend yield of 1% might not be the highest, but their consistency and low payout ratio, which is about 35 to 40% of their earnings, make them a really reliable choice for income investors.
It's all about that dependability, especially during a bear market. Now, what about volatility? Walmart is known for having a pretty stable stock price, which can be reassuring when the market is all over the place.
Their beta is around zero point 0.5, which means their stock is only half as volatile as the overall market.
So they're not going to be swinging up and down like crazy.
Exactly. They offer a much smoother, more predictable ride, which a lot of investors find appealing when the market is uncertain.
They're the steady Eddie of the stock market, always delivering solid results.
I like that. And their recent performance shows just how stable they are. Even though their stock price dipped a bit after their fourth quarter earnings report, they're still up significantly over the past year.
Okay, so they're not totally immune to market fluctuations, but they seem to hold up better than most when things get rough.
Absolutely. Their predictable revenue streams, their size, and their diverse customer base all contribute to that stability.
Before we wrap up our discussion on Walmart, is there any news or recent developments that investors should know about?
Well, their fourth quarter earnings report for fiscal year 2025, which came out on February 20th, got a lot of attention. They beat expectations for both earnings and revenue, but their stock price actually went down about 6% after the report because their guidance for fiscal year 2026 was a bit weaker than some people were hoping for. They also talked about some potential challenges like tariffs and currency fluctuations.
So it's a classic case of buy the rumor, sell the news. The market was expecting great things, and when the results were good but not amazing, some investors decided to take their profits and run.
That happens a lot with companies like Walmart, but just a few days later, they announced a 9% increase in their dividend, and their stock price bounced back, jumping 3.4%.
So that dividend increase reassured investors that Walmart is still focused on giving back to its shareholders.
Exactly, and there's been a lot of talk among analysts about how Walmart stacks up against Amazon. Even though Amazon might have overtaken them in terms of total revenue, Walmart is actually more profitable. And their huge network of physical stores gives them a real advantage in areas like grocery delivery and instant pickup, which are becoming more and more popular.
So they've found that sweet spot between online shopping and brick-and-mortar retail.
They have. So while Walmart might not be the most exciting high-growth stock in the market, their solid track record, consistent profitability, and those defensive qualities make them a great choice for investors who are looking for stability and income, especially in a market that could be headed for some turbulence.
That's a great point. And that brings us to the end of our discussion on those top 10 stocks that we think could thrive during a bear market. We've covered a lot of ground today, from healthcare to consumer staples to telecommunications and retail.
Yeah, we have. We've seen companies that are innovating, adapting, and showing real resilience in the face of some tough challenges. And we've seen that there are opportunities for investors in every sector, even when things are a bit uncertain in the market.
Absolutely. It's all about finding those companies that have the right mix of financial strength, a clear vision for the future, and a commitment to taking care of their shareholders.
And remember, this is just a starting point. It's important to do your own research, think about your own investment goals and your risk tolerance, and talk to a financial advisor if you need to before you make any investment decisions.
That's great advice. Investing is a personal journey, and what works for one person might not work for another.
The stock market can be volatile, but with a little bit of knowledge and a good strategy, you can navigate those ups and downs and reach your financial goals.
We hope you found this episode of Investing Talk Podcast helpful and informative.
If you did, please subscribe to our channel, share it with your friends, and leave us a comment below. We'd love to hear your thoughts and answer any questions you might have.